Okay, so let's start off with some practical, real world questions about business. Okay. Most of us shop regularly. We know kind of what to expect when you go into a store. So let's start with this question. Why do businesses accept credit cards and debit cards? What is the benefit for the customer and for the business? Anyone have want to volunteer any ideas? Yeah, Scott. Okay, so you're saying for the customer, you can potentially use credit, right? Okay, so that's true. The person who's selling you the item, the merchant, is actually getting their money right away. You can pay later, but the lender is some other party. It's not like, Best Buy is lending you the money when you go buy an iPhone there, right? It's some bank that you have the credit card with, right? Okay. But yes, you're right. It did facilitate the transaction because if you didn't have the money and you needed to borrow to buy it, the merchant benefited because you were able to buy it right now instead of later. Okay? Yeah, that's one. Okay. Yeah, exactly. Okay, so for the business, it's a benefit because there's less cash handling. Okay, yeah, so it's a prevention of theft from the employees, from third-party thieves, right? So yes, that's definitely a benefit for the business. Well, again, the merchant is not the one who's lending the money, right? If you get a credit card from Chase Bank, Chase is actually going to pay the merchant up front, and then you owe money to Chase. You don't owe money to wherever you bought the item from, right? So, but yes, in general, for the customer, it gives access to credit. Okay, what else? You guys didn't exist when you had to carry around a bunch of cash. Um, but for the consumer, you just don't have to have this bulky paper with you, right? You have one credit card and you have access to all your your whole bank account. You don't need to have the physical stack of cash with you. Okay? Anything else? Yeah. Eh, For you, the consumer, right? Yeah. Again, the theft thing too. If someone steals your credit card, you can just call and have it canceled right away. But if they steal your cash, it's gone, right? Um, okay. So what companies are involved with this system? So we mentioned one of them, like Chase Bank, right? They issue credit cards, but are they the ones that are kind of facilitating the whole network? What are the companies involved with that? You see it on your credit card. There's two big ones. Interest, which one? I- Interest? What are the companies? What are the names of the companies involved? What is it? Yeah. Credit union, yeah, they can issue a credit card also. So just like Chase Bank, just like Wells Fargo, um, Capital One, these are like credit card issuers. But are they the ones that facilitate? Are they connecting the merchant? Are they connected to all the merchants directly? How does that work? Yeah, exactly. Exactly. So these are credit card networks, right? Visa, MasterCard, they're the ones that facilitate when you swipe your card, it's through their network of communications, financial kind of this communication network for financial institutions that connect Chase to Best Buy. And, Best Buy will say, hey, is this card approved for $500? The Visa MasterCard network is facilitating that communication between the issuer of the card and the merchant. And they charge a fee for that, right? That network communication, they're gonna take like a little piece of the transaction amount. Okay, so they charge the bank makes money through charging you interest. If you have a credit card, you have a balance, they're going to make money most directly by um, basically charging you interest on any debt that you have outstanding that you don't pay off at the end of the month. Visa, MasterCard, they make a piece of just the transaction. Okay. So when you pay $500, not all of that is going to Best Buy. They're paying some of that to, uh, you know, the the fee for swiping that card is going to bank partially. You know, there's like some sharing agreement between the bank and Visa, Mastercard, which is why Costco. I don't know if people have noticed. I think it used to be Mastercard, now it's Visa, or vice versa. Exactly. Okay, so it used to be American Express, now it's Visa. Is that right? And the reason why is because Costco is like, well, you need to give us more of this interchange fee because they know that they generate so much volume for the credit card network company. So Amex runs one, Visa, MasterCard, these are all competitors. So Amex was not willing to share as much of their profit with Costco as Visa was. So Costco said, forget you, we're going to switch to Visa. Okay. So it's because they're trying to divvy up the share of this interchange fee that gets charged when you swipe your credit card. Okay, so again, the parties that make money are really the network operator. So Visa, Mastercard, Amex, Discover, which no one really uses, but it's one of the other ones. The bank, if you don't pay off your balance, they're going to start charging you interest. So that's how they make money. And they also can negotiate to get, they're like when you have a cashback credit card, it's not really like cash back. It's like they're just kind of giving you back some of the interchange that they make because of the total amount. Some of it Visa and Mastercard take, and some of it credit card company takes, and they're just kind of giving you that back to incentivize you to use their card essentially because they're hoping that you're going to keep a balance on it. They'll earn interest. Okay. Okay. Any questions on this? This is like this payment processing world is like very deep. Okay. Now there's competitors to this Visa, MasterCard kind of duopoly. Like when you use Apple Pay, if you use Zelle, these are all ways that are bypassing Visa, MasterCard network. Okay. So now they have competition that's outside of the traditional credit card kind of game. Yeah. Yes, exactly. Yes. Like when you pay each other through Venmo, there's no fee, right? Like when you pay your friends, it's because you've bypassed Visa, Mastercard. You're just doing it through their kind of payment network. Okay, so this is a little dangerous for the Visa, Mastercard, but they still have like massive amount of the market share. These other things are much smaller. Square operates like the device, but they're using the same payment processing. Like they're still swiping a Visa or Mastercard credit card, right? So they're paying the fee that they charge is also just for having that point of sales device and interacting with the Visa Mastercard network. So yeah, so there's some fee that's charged, and it's all divided up by all these parties: the credit card company, Visa, Mastercard, the point of sales device operator. All these parties are kind of sharing that fee with different agreements between them. Yeah, they're all what? Yeah, yeah, that's true. And I think they've started charging for business transactions because a lot of people will like they can accept credit cards. So now they're also getting into this game of like charging a fee for business purposes. Yeah. Okay. Any other questions on this? There's a lot. I mean, this is a huge industry because it's like how much volume of like transactions happen in the economy. All these companies are taking some percentage of that. So as long as there's people buying and selling things, these guys are always going to make money. So it's like a great business if you can get in, but it's obviously like creating the network is very difficult. Okay, any other questions? Move forward. Okay, so let's talk about how to account for this. Um, so again, most businesses accept these payments, and it's beneficial for them because their customers kind of demand it now. Now it's like the standard. There are some, maybe some restaurants, some very niche, high demand people can just demand cash. But for the most part, most people selling anything are going to accept this because it's like what the customers kind of expect. Okay, so um, So, we should learn about how it's accounted for. Um, okay, so there is some point of sale system that's used. So you have to swipe the card, or now we have, tap payment. But that device is somehow going to interface with the payment network. Okay. Um, there's two ways that you can account for the fee. So let's say the fee is like 4% of the transaction, which is not kind of too crazy. Debit cards are cheaper. Okay. How I don't know exactly the details of why that is, but when you swipe using your debit card, the merchant, meaning the person selling you the item, is going to pay a much lower fee. And it could be because there's less uh, gateways, because there's no. It's like it's going to just check if the money's in your account. There's no bank, like third party bank to interface with. I don't know the reason, to be honest. But debit cards are going to be like some fraction of a percent. The credit card swiping, Amex, for example, why a lot of merchants don't like to take Amex, they charge like 4 or 5, 6%. Okay, so they charge a lot. But their customers, who has Amex cards? Are they people with small credit limits or large credit limits? Usually large, right? So if you are selling Gucci bags, you probably will take Amex because the customer uh, is maybe going to have an Amex card, and Amex offers really good benefits to their cardholders. So people that are, have more money, they want to have an Amex card because all the various perks you get with that. So if you are a merchant and you want to attract those customers, you also have to accept Amex and just pay the larger fee. Okay, but not, like a lot of merchants are not willing to do that. Okay, so they're like, we're not going to take Amex, right? Because the fee is too much. Okay, so basically some percentage of the transaction is going to get paid as an expense to this third party kind of uh, payment processor. Okay, so we have two ways that we can account for that. The net method is that in each sales transaction, we will account for this fee expense. It's an expense in that sales transaction journal entry. Okay. Um, the gross method is that when we first journalize the sale, we assume that we're going to basically, if the sale was for $500, we assume that we get all 500, and then at the end of the month, we pay. The credit card processor will give us a invoice, and we pay it at that time. So that it's kind of like a end of the month. It's not quite an adjusting entry because it's a real expense. It's not like a deferral or an accrual, but you will at some point actually pay that expense and account for it then. Okay. So again, the net method is all in one shot, just accounting for the expense when it's incurred. The gross method is accounting for it kind of on the back end. Okay. So let's look at an example. So we made a $3,000 sale on this date. There's a 4% transaction fee. Okay, so the net method, we record the entire amount of revenue. Okay, because this is actually the amount of the total value of the sale was 3,000. It's just that we have now this expense associated with the sale. Okay, so we're gonna have the credit card transaction fee right here, 4%. It's a debit, just like all expenses are. And then the amount of cash that we're going to have kind of deposited into our bank account is the remainder. Okay, so this is, again, now you can understand from the perspective of some merchants, especially small businesses. They may be like, oh, if you could pay in cash, right? The reason why is because they want to avoid this. Okay, they get the full amount of the sale if you pay with cash, or if you pay with the debit card, the fee is much smaller. Okay, so there are yes, we discussed some of the benefits they have. They also don't have to deal with the cash and like the security around that, but they're also paying a fee for it. So they would prefer you to either pay with the debit card, or probably checks now are not really accepted because those checks have their own problems. Um, but yeah, if you're like homies with your local corner store or whatever, you should always pay with the debit card. That's the cheapest for them. They got to keep more money for themselves. Okay. and definitely don't use your Amex card. That's like the worst for that. Okay, any questions on this journal entry? Everyone good with this? Okay. So again, this is just one method. This is the net method, meaning in this transaction, you expense it right here, okay, at the same time that you're recording the revenue, okay? Now the gross method, okay, there's two separate journal entries you can say. The first one, you're gonna just take all the cash in, okay? Maybe you've set it up with your credit card processor where they're gonna give you all the transaction amount up front, and then they're gonna bill you at the end of the month or something, okay? So in that case, you're gonna use this gross method. You're gonna get all the cash, and then at the end of the month or whenever you get the invoice, you will then pay out the cash you'll write a check or whatever to the card processor, so Square or whoever, and you'll record the expense at that time. So the net effect is still the same, right? Because in this case, you would have had cash 3,000, and then you would have had this cash come out 120. So you would still end up with 2,880, just like you had here, right? But it's just two separate transactions. So the net effect is still the same. It's just like kind of two different methods depending on maybe how your payment system is set up that you can do it. Okay, any questions on this? I think it's pretty straightforward. I think the more interesting thing is just knowing about these payment networks. That's really maybe the general knowledge takeaway from this. Okay. Um, okay. So any clarifications? Everyone good with this? Yes. Okay. Okay. So now let's talk about just banking. Okay. So um, when your business uses banks, the bank itself has a bunch of stuff set up to kind of safeguard this asset that your business has, which is cash. Okay. Um, so for example, they have signature cards. Okay. So when you have like a business account, usually, and now they probably have some AI, like, image recognition that checks like the images for every check, and it probably has some pattern recognition. But basically they want to make sure that any check that you have or anything that you signed is actually your signature. Okay. And so they have ways to reject any check or any document that is deemed to not be your actual signature. And so back in the day, they would just have a card, like a physical card that you would come and sign. And before like everything was electronic, they would compare your signature to whatever checks they received to make sure it's legit. Now it's kind of done electronically, and it scans the check and does all this other stuff with tech. But really, the goal is to prevent forgeries. Okay, so they have that. You have receipts for everything. So when you make a deposit, there's going to be some record of that. They'll give you a printout, or now it's like all electronic, so you can log in to your bank account records and see everything. So there's always going to be like a very transparent paper trail for all deposits and withdrawals. They're also going to have statements. And again, back in the day before the internet, they would mail you a paper statement every month. Okay, now they still provide, there's still a monthly statement, but it's like a PDF, and now you can have like real time tracking of your bank statement by just using the internet and like your account online, right? So this bank statement kind of thing is old school, and it'll probably disappear at some point. There will probably be probably like by law, they have to do it just because the bank regulations are like written a long time ago. But at some point, you could assume that they're going to phase it out because like now you don't really need a monthly statement because you can just track your bank account like real time. You don't need just a once a month update. What was that? An actual statement. Yeah. Yeah. But soon they'll have ways. I have a friend that worked on a startup where they will, like a loan processor or like a mortgage lender or like even a landlord, they will have a way to interface and connect to all your financial stuff directly, right? So you give them permission, and then they will then just be able to like kind of log in and like have access to your bank account, like your all your credit information, and it would be easier for you, right? Because you right now you have to kind of download everything and email it and all this kind of stuff. Um, but yeah, yeah, there are plus and minuses, definitely, definitely. But yeah, it's not necessary. It is just the way it's done now. But the technology exists to kind of even get rid of that. Okay, and then checks. Okay, so this is how many people have written a check in their life? Okay, so still medium amount. Now people pay rent, and usually like the big use of checks is like writing, like if you have a business, paying a lot of your expenses. But for like regular people, just paying your rent, you would use the check usually. But now I think people use Venmo, and a lot of landlords have like a online portal to make direct withdrawals. So I think check writing is kind of getting phased out too. Um, but it is a document. Um, it is a record of a transaction. Okay, so we'll look at a check in a little detail, but the bank kind of produces the checks, and it has certain safeguards too. Okay. Okay. So all right. Any questions on this? Okay. Okay. So what is a check? So this is the actual check here. I hopefully many of you have seen this. This is just like if you have a business account, you'll get like a checkbook that has a way that you can also write what the check was written for. Because once you write the check and give it to the person, it's kind of gone, right? I mean, nowadays once the person deposits it, it gets scanned and it gets put on your online account. But back in the day, that didn't exist. So you would have to have some place to record what the check was for, which is kind of this top part. Okay, so uh, who are all the different parties involved? Okay, so there's three parties to every check and to every payment, you can say. Okay, so the maker, which is your business. Okay, so it's this party here. Okay, the person that's getting paid. So this is right here, and then the bank. Okay, so this is the bank information, and really this is the bank information. This is a routing number and your account number. Okay, so it's like an address. It's telling so when this person gets the check, they're going to give it to their bank and say, hey, this money is for me. Their bank has their account information, right? Because it's their bank. Their bank will then use this address to be like, okay, this is the bank that I need to go talk to. And then this is the person, or this is the account at the bank that this money needs to come out of, right? So uh, basically, this routing number goes to this bank. And so the person who deposits it, their bank will talk to the person who wrote the check's bank and be like, hey, does that person have $300 in their account? If the answer is yes, then they say, okay, I have a check that your person wrote to transfer $300 from their account to my person's account. Okay, then your bank, if you're this company, will say, okay, well, show me the signature. Let me make sure it's legit, that my person actually wrote the check. They'll verify that this signature is indeed the owner's signature, and if so, they will initiate this transfer. This is why check clearing takes a couple of days, because it's basically this process happening. Of course, it's not like a person calling back and forth. It's all electronic. It's all done in an automated way. But essentially, that's what's happening behind the scenes. Your bank, if you're the person depositing it, is talking to the person who gave you the check, their bank, verifying that the funds are there, and then the clearing of the funds. Okay, so that usually takes a couple of days. Okay, any questions on this? This is also like a old school uh, way of doing things that still exists. This is like how a lot of transactions are still kind of cleared in the country, and it's still going on. Yeah, Ella.
My credit. So I made an account for the first time last August, and then they're like, "Oh, we're gonna give you 5 sheets." Is it? Okay, they said we're gonna give you 5 sheets of checks for free, but then if I ever needed more than that, then I would have to pay. So why do we have to pay for like the actual paper checks?
Yeah, I mean, it's a cost for them. They have to get them printed and stuff. And now they probably know that a lot of people don't use checks, so they're like, if you want it, then you got to just pay for it. They're now not offering that as like a free benefit because a lot of people probably don't do it. And there's a cost. They got to print it out, and there's some cost to it, and it's not that much. It's probably like $20 for like a bunch of checkbooks. So, but they're just not giving it to you for free anymore. Yeah,
Thank you.
yeah.
You didn't mention the last line, and I'm actually interested to know if it's
Okay. Okay, so yeah, let's go through these. So the checks are numbered. So again, there's a check number here and number here. So you as the writer can keep track of your checks because now it's all electronic. It'll show up on your bank account. But before, back in the day, on the statement, it would just have the check number, and you can see if 201, 202, 203, and 205 have been deposited, you'll know like 204 is still floating out there, right? So the check number is also helping you kind of keep track of what's going on with your checks. Um, okay, so written amount versus numerical. So which one is the official? So if you wrote 300 here, or let's get rid of some of this. Okay, so if it says 300 here, but let's say this was 3,000, which one is the bank gonna follow? Who do you think is the official? Yeah, what do you think? Yeah, huh?
Written one,
Why?
because you can just add another zero.
Okay, yes, that's correct. The written one is the official. That's why they have you write it. Okay, because this can be manipulated. You can like get some white out, put this and move this over and mess with the written number. Okay, so if there was ever a discrepancy, they're gonna just follow what is the written amount. Okay, and this is another check or another safety feature of the check, right? They want to make sure that there's no fraud, and really this is just kind of like a convenience thing. The official one is this. Okay, yeah, and the remittance advice is just the top section. This is just stating what the check was. If once you've made the check, you've given it to the person, so you still have a record of it. Okay, any questions on this? No? Okay. Okay, so then the bank statement also is another kind of document that's useful, and it has its own kind of details that are important. So again, what is it going to have on it? It's going to have beginning and ending balances. Um, it's going to have whatever was deposited into the account, whatever checks were written. Not just the checks that were written, though. It's the checks that were written and deposited by the person, right? If you wrote a check to someone and they just have it in their wallet and they haven't deposited it yet, it's not going to show up on the bank statement yet because the bank is not yet been asked to take the money out. That's only going to happen when the person you gave the check to goes to their bank and deposits the check, right? Until then, it's just floating in the ether. And maybe they lost the check. They're going to call you up and be like, hey, I lost the check. Can you send me another one? At that time, luckily, you'll have numbered checks. You'll remember, hey, check number 207 was written to them. You'll call your bank and be like, do not deposit 207 because I'm reissuing that check. Because the person could be scamming you too, right? They could have your check, call you and say they lost it, and then you'll give another check and they'll just deposit both of them, right? So you would have to take the preemptive step of canceling that original check that you wrote, just so you don't get scammed like that.
so you say that if you're canceling, that means they haven't taken the money yet, but
Yeah,
once
so
you get
okay, so
from the account,
yeah, so okay, so canceled check means in this context, what they're showing you on the account is those that are deposited, and they are canceled because let's say they somehow were floating in the street, the bank would have already processed it, so they wouldn't process it again. But you can, before it's deposited, also cancel it, meaning it can't be deposited. Okay, so yeah, so in this context, when the bank statement is going to show it, That means that the check has already been deposited by the person into their account. I guess stop payment is the technical. Yes, that's when you've given the check, but you don't want that check to be actually transacted. So that's the case where you gave the check to someone and they said they lost it, right? Then you don't want that check. Now you want that check to be like non-existent. You don't. If it later comes in, you don't want it to be transacted, right?
That's right.
So then you would call the bank and say, "Hey, issue a stop payment on check 207 or whatever it was." And so even if that person afterwards, after you made the stop payment, if they try to deposit it, the bank will not honor it.
That is clear. But what is already withdrawn from your account?
Yeah, so that's what I mean. The terminology is cancel check, but yeah, the bank has that check technically, right? They back in the day they would give you the check back, and they say that here's your check back to you that's already been transacted and it's been canceled. So that check is still physically there. They would have returned it to you.
Means no money was taken from your
No,
account
it means that money was taken from your account
by
by whoever you gave the check. So you gave the check to someone, they gave it to their bank sent it to your bank verified the signature was okay, and then gave the money to them. Now your bank has that check that you originally wrote. They would have probably stamped it, said it's deposited, and given it back to you.
no money.
Yes, money, yes. Yes, the money did. So look, you give the check to this person, right? They go to their bank, they give this check to them. This bank goes to your bank and says, "Hey, here's this check that was given." So now the check is here at your bank, back to your bank. Verify the signature. Your bank verifies that yes, this check is good. They'll transfer the money here to this person's bank, but now they still have your check. They will then stamp it and say it's deposited. And back before they would then you could go get your canceled check back. Because it's now the money's been transferred and now this check is kind of the whole round trip is complete. It's done.
The person gets the money.
Yes. Yes. After your bank verified that the signature that you had originally done this, they will give this person the money as you instructed.
So canceled otherwise would mean processed money sent
Yes.
to the receiver.
Yes.
It's no more needed.
Yes, correct.
Okay, then why would be needed?
Yeah, I mean just for your records, Yeah.
Yes, thank you.
Record keeping. Yeah. But yeah, stop payment is different. That's where you gave the person the check, they lost it or whatever, it never got here. And you just want to say, this check, just if it comes in, don't do anything with it. That's stop payment. Okay. EFT payments. So it will show some people will deposit money directly into your bank account and you never were notified of it, right? It's going to show up on your bank statement. Okay. Or if you get a wire transfer or something. Okay, so the bank statement is actually the source document for that payment. You'll see it show up there. Also, you'll make payments. So who's set up like auto pay for their utility bills or whatever, right? Yeah. So you don't actually write a check. There's no document that you've created to memorialize that transaction. It's just going to show up in your bank statement. The bank service fees, again, they'll just take the money out of your bank balance for any fees. Which is a real cost, right? So for your accounting system, you're going to have to account for that loss of cash, right? You're paying the bank some money. You would have to need the bank statement to see those fees, right? Because they never sent you an invoice. They usually just take it out of your account. But you need to have that expense reflected in your accounting system. So you would see that on the bank statement. NSF, non-sufficient funds checks. What do you think that means? Okay, this is checks that you tried to deposit from someone else and they were not, the check bounced, right? So your bank would be like, well, we tried to verify or get the money for you, but we couldn't get it. Okay. So in your accounting system, you're like, yay, I got money. But at the end of the month, when you get your bank statement, you're gonna be like, actually, this cash didn't actually come. So my accounting system is wrong because I kind of preemptively said I got the cash. I assumed that the money was there. But at the end of the month, if you saw an NSF check, you'll have to change your accounting system because you'll have too much cash recorded. Yeah.
Who is receiving the penalty?
Um,
Because the first check like $30 fee, right?
yeah, I believe it's the depositor that pays. So that's why, like, if you're a landlord, if your tenant's check bounces, there's a fee that you impose on them to compensate you for paying this NSF check fee. So it's from what I understand, it's the depositor. Yeah, not the bank is not going to, because the bank didn't transact, right? There's nothing. They just tried to verify if the funds were there. The funds are not there, so they're just like, we're not going to do anything with this. It's garbage. But the fact that they had to do that communication, they're going to charge you some processing fee um, to do it, And there's probably scammers that try to like cash bad checks or like deposit bad checks. So it's an incentive to like not do this. There's probably some costs that they have to do to manage these bad checks. Okay. Again, the key thing is that your accounting system has a balance of cash, right? You're going to have accounted for all your transactions and you're going to have some balance. The bank statement is also, and so this is, let's say, July 31st. Your July bank statement is also going to have cash as of July 31st. These two are not going to be the same, okay? For various reasons. We listed some of them. If you had an NSF check, you would have debited it to your accounting system, but your bank statement is not going to have it because that check didn't go through. The bank fee, you never got any invoice from the bank, so your cash here is going to have too much cash because it doesn't have that bank fee. But this bank statement cash will have the fee, right? So there's a discrepancy between your accounting system and the bank statement. They should be the same, right? The amount of cash that your balance sheet shows should be the exact same that your bank statement shows, right? But there's differences for various reasons between your bank statement not including certain things and your bank statement including things that your accounting system doesn't. So it works both ways. Okay, so let's see what I have here. Where's this bank statement? Okay, so this is like a bank statement example. Okay, so this is just like a test person. This is their. So it gives you a average balance for the month, service charge. It looks like they earned some interest. So they have a previous balance, right? So this is a starting balance plus the additions minus the subtractions give you the ending balance. It's the same beginning balance plus additions minus subtractions ending balance. This is the same framework they're giving you for now in the context of a bank account. It's going to list all the transactions. So you can see credits, debits. So these are deposits. These are all the withdrawals. Sorry, other way around. These are the deposits. These are the withdrawals. It's going to list the entire month. Okay, now it's going to have all the checks that were cleared. Okay, so all your check numbers, and then it's going to have your balance every day. Okay, so probably a lot of you have seen your uh, your bank account balance or bank statements. So this is just an example. Um, let's see, 7, 8, $100, 7, 8, 19. We should see a debit for $100. Hmm. Yeah. Now, why the checks are not incorporated here? That is unclear. I don't know if it's because it's a fake account, but you would expect that the checks would be debits, right? You would see those amounts coming out. Okay. Um, so why that is, I don't know.
These are checks that you pay or cash out?
I mean, my understanding is that these are going to be checks that you wrote, right? That's why they're all numbered sequentially because they're your checkbook, right? If they were from random people, they'd be like random check numbers. Yeah. So yeah, I don't know why that is. Again, this is probably because it's like some uh, fake statement that I found on the internet. Okay, just to show you what the sections are. Okay, that's really the important thing. Okay. Okay. Any questions on this bank statement? No. Okay. 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 So now the main part of this whole chapter, the hardest part, is this bank reconciliation. So as I explained, uh, there's going to be a difference between your accounting books and the bank's records. Okay, why are they different? Now let's talk about the major classes. So timing differences. Okay, so there may be misalignment between when something enters your accounting system and when it hits the bank. Okay, so an example of this is deposits. Okay, so let's say you've collected a bunch of checks from your customers, it's sitting in your office, you've gone to your accounting system and accounted for them, you debited cash, credited accounts payable or whatever it was, or revenue, whatever that journal entry was. You did the journal entry, but you haven't yet gone to the bank and actually deposited the checks. Okay, so that timing difference is going to show a difference between your accounting system balance for cash and your bank account. Okay, so this is a important one, especially if you're collecting checks at the end of the month, right? The bank statement is produced as of the last day of the month, but if you collect checks on like 2 days before, maybe you didn't have time to go to the bank. Okay, so a lot of this will happen towards the end of a period. Okay, when the bank statement cutoff is happening. Another one is checks outstanding, meaning you had a PG&E bill, right? So you wrote a check to PG&E, you went to your accounting system, you debited utility expense, credited cash, but PG&E just is sitting on that check. It's like kind of they have deposits in transit, meaning they have your check, but they haven't deposited it yet. So your accounting system, again, will have that cash credited, but the bank has not yet taken the money out of your bank account. Okay, so this is going to fall again into this category of timing differences. Okay, so this timing differences. Okay, so another one we kind of touched on is the bank statement is a source document for certain things. Okay, so you haven't yet received any other source document for certain transactions. So for example, EFT and direct deposits. You'll have to look at your bank statement to see those transactions. Okay, so it is going to be what triggers you to do the journal entries, looking at your bank statement. Okay, so EFTs and direct deposits, again, the bank fees, right? They're going to list how much they charged you as fees. The interest that you earned, right? That's also going to be on the bank statement. And then whatever NSF checks you thought were deposited, you had accounted for them in the accounting system, but the bank statement is going to show you actually they did not go through. Okay, so again, the bank statement itself as a source document is another reason why we need to reconcile your accounting system and the bank statement. Okay, and it could be that there are errors. Okay, there could just be some mistake that you made. Maybe you debited $100 to cash because you collected some money, but the check was for $1,000 and you just made a typo. Okay, so that would be a case that the correction has to happen in your accounting books because the correct amount was 1,000. You only debited 100. Okay, it could be that the bank made a mistake too, and your accounting system is correct, but the bank made an error. Okay, so errors, it could go either way. You don't know which side is wrong. Depends on the error. And so the goal is to basically make adjustments both to the bank balance and to your accounting system balance and get them to match each other. Okay, because they should be in agreement with each other after these adjustments. Okay, so that's what this bank reconciliation is attempting to do. Okay, so let's go through these and see which ones are which. Okay, so if you had a deposit in transit, okay, is that going to be, is my bank account balance going to be understated or overstated? Who votes understated? Who votes overstated? Okay, yes, it's understated. So that means we'll have to add deposits in transit to the bank balance. Okay, so again, if our bank balance said we have $700 as of the end of July, but we know that we're sitting on $100 of checks that we have not yet deposited, we would have to add that as an adjustment to this $700. We'd have to add it to make the bank balance correct. Okay? What about outstanding checks? Do we add or subtract to our bank balance for the checks that we know are outstanding? Subtract, yes. Because when they are deposited, it's going to reduce our cash balance. So yes, that would be a negative adjustment. So if we knew we had a $50 check outstanding, we'd have to subtract. Okay, what about bank error? We kind of mentioned this, right? What is it? Add or subtract? Both, or it could be either. Okay, it depends. So this depends on the error. Okay, what if you have bank collections? Okay, so now this is kind of like we're talking about what do we do to our accounting books, right? Because the bank collection is obviously going to be reflected here in this $700 because the bank collected that money. But our accounting books have not yet accounted for it. So is that going to be a debit or credit? Really, that should be the question, D or C. Should we debit or credit for the bank collections? Cash. Yeah, debit. So we would debit cash, but what we credit would depend, right? If it was a customer sending us money for an account receivable, we do, debit cash, credit account receivable, right? So we would have to know what the cash was coming in for. Okay. Service charge. Is that a debit or credit? Credit. Okay, good. Interest revenue. Debit. Good. NSF. Check. Everyone good with credit? Credit is right. Because remember, we had initially, let's say someone gave us a check for $100. We would have debited cash $100. But the bank is telling us, hey, that check was bad. Okay? So to correct for that, we'd have to credit cash $100. Okay? And then what about a book error? We just made a mistake in our accounting books. Is it a debit or credit? Depends. Good. Okay, good. So let's just quickly look at the format of this bank reconciliation, and we're going to just pretty much for the rest of the class just practice doing them. Okay, so as you can see, there's two sides, bank and book. What you're doing here is starting with the ending balance that each of these say. Okay, so you can see as of April 30th, as of April 30th. So we're now at the end of the month. We're taking the ending balances and we're going to reconcile them together. Okay, so be very clear about that. This is, I think, a big source of confusion. You're not reconciling the transactions that happen in each. You're just taking the balances that these should be in agreement, right? You would think, theoretically, they're both ending balances of cash. They should be the same, but they're not for all the reasons that we just discussed. Okay, so you're going to start with the ending balances that each of them say. So for the bank balance, this is going to be in your bank statement. For your book balance, this is going to be like your T account, basically. You're going to have all your transactions, whatever. At the end of the month, you would have had a debit balance of 20,850. Okay. Now you're gonna make your adjustments. So for the bank side, you can see here that you have a deposit in transit, which again, this 9,000 is reflected already in here, right? It was already a debit to cash, but it's not yet reflected in here because it's still in transit. So that's why we're adding it. And then this outstanding check, we're going to subtract this because again, this 2,000 is also in here in this 20,850. It would have been one of these credits. Okay, but in order to now get it kind of reflected in the bank, we're going to do an adjustment. So we get to this balance for the bank. Okay, so now we take everything that's in the bank statement that's not in the accounting system and do the same thing. So we start with the book balance. We have some EFT payments. So again, this information is going to come from the bank statement. This information is going to come from the bank statement. So these are additions. Okay, so we're going to add this. And then we have a bunch of stuff. Service charge. We have an EFT payment. So this is the amount that we paid out. And we have an NSF check. We have these negative adjustments. And we basically should get to the same number. These two should always agree with each other after we've done these adjustments. That's when you know you've reconciled everything. Okay? Another key thing to keep in mind is that this deposit and these outstanding checks, they're already in your accounting system, right? So you don't need to do any journal entry for them because they're already there. You were just including them in the bank balance because they're not reflected in the bank balance. All this stuff on the book side of the reconciliation, they will need a journal entry, right? Because all this stuff, it exists. It's an economic reality of your business, but there's no journal entry yet. Okay, so everything on the book side, this stuff will all require you to actually change your accounting balance by doing journal entries. Okay, is everyone clear on that? It makes sense? Okay. Okay, so now we'll start one of them. I'm hoping to do two of these, okay, because these are tricky. I think if you can see it at least twice, it's going to benefit you to do the homework. Okay, so let's start with 7-21. If you open your Excel sheet, and I think we'll have time to do two of them. So let's just try to get through those. Okay, so again, the point of this is to take this ending balance, which is in my books, and this ending balance in the bank statement, 370, and this 1,325, and reconcile them because they should agree with each other. Okay, so on the bank side, I start with my bank ending balance, 370. This is the starting point. I know that this is incomplete because there are things that are in my accounting books that are not yet included in this bank statement. Okay, the first one, deposits in transit, which I've already mentioned. So add deposit in transit because again, if I look at my bank statement, I only show $130 of deposits. But if I look at my accounting books, which again, this is kind of like my cash balance, I have this 130 deposit, which is in there. But this one, which happened at the end of the month, it's not yet included. So this one is like cash that's still at my business or whatever that I haven't gone to the bank yet to deposit. But it should be included in my cash balance. So I'm going to add that in. Okay, so what else do I need to add in or subtract in? Add for the bank side, really that's like the main one, okay, deposits in transit. What we could have to subtract are checks that are outstanding still. Okay, so if I look in my bank statement, there's 4 checks that got deposited. If I look in my bank statement or my checking account, I've written 6 checks. So I know that some of them are still floating out there, meaning that the cash is spoken for. It's like cash that I've kind of already like spent, but it's not yet actually been taken out of my bank account. Okay, so my bank account balance is overstated by those checks that are still floating out there. So if I look, I see 622, 23, 24, and 25 are all deposited, but 26 and 27 are still floating out there. And so these two amounts, 85 and 265, I need to subtract out of my bank statement. Okay, so these are subtraction checks outstanding, and it was 265 and 85. Now, I think when you do your homework, it's going to have you list each one individually. You'd have like check outstanding by check number and like list them individually. I'm just putting it as one number, okay? Just for simplicity. Okay, and then you can say, is there anything else that's not accounted for in my accounting books or in my bank account that's in here? No, this deposit is now included, and all the checks are included because these four were already included, and I just did an adjustment for these two. So now everything here is included in here, in here. Okay, because this contained most of it, and then whatever was missing, I've now done adjustments. So my adjusted balance equals this starting balance plus the deposits in transit minus this is 1,230. Okay, so now let's do the book side. So my starting point is this ending balance in my accounting books, okay, 1,325. Okay, so um, what do I have that's in the bank statement but not here? I can definitely see these two bank charges. Okay, I'm gonna have to definitely subtract those. And I also see that this error, okay, if you saw this little star, it says this is the correct amount for check number 624. So $115 should have been the amount for 624, but in my accounting books, it's only 75. Okay, so basically in my accounting books, I have this, and again, it's a subtraction, right? This is amount that I'm paying out. So I had $75 as a credit, but really, here's a little more practice with T counts. It should be 115. So what do I got to do to cash to correct for that? How do I go from this to this? Credit $40, right? Because if I did this, then it's going to work. So that means it's a subtraction to cash. That's the error adjustment is going to be a subtraction. Okay, this balance here is overstated by $40 because again, this uh, whatever this should have been 115. If this was 115, then this balance would be $40 lower. So that's the adjustment that I'm going to have to make, at least for the error. So subtract for error, book error, $40. And then I have those two fees, printed checks and service charge. Okay, so printed check charge. So Ella, there you go. They're charging, printed check expense, we'll call it, and then bank fee expense. Okay, so what was it? 35 and 20. And all of these adjustments are subtractions. Okay, so I don't have any deposits that came into the bank statement that I have to account for. These are all going to be subtractions. So I go this minus the sum of this. Okay, and we can see here that they agree with each other. And this shows now that it's complete, Now we've done whatever we needed to the bank statement to include things that were in the books, and things that were in the books or errors we've now corrected. Okay, so now everything here, as I stated, these three things need to have journal entries because really this is the balance in my T account. Okay, so if I looked at my T account for cash, I mean, really what happened, you can see everything here. It was 540. And then, whatever, we had deposits of 130 and then 1,210. And then we had all these checks written, whatever, all these 6 checks. Uh, that totaled what? 540, 580. She was 540. Okay, so if I do this, oops, what am I missing? 15. That's why. Okay, so this is the state of my accounting system, but we know that it actually it should be this, right? So we need a total of 95 credit, because if we did that, we would get, oops, yeah, we get to the right balance. Okay, so where are these credits going to come from? We need to do 3 journal entries because the total of this is 95. Okay, so they're all going to be credits to cash, all 3 of these. Agree? Because we need to, basically it's this minus this minus this minus this. Okay, so I need 3 credits to cash to make my accounting books correct. Is everyone okay with that? Now the question is, what are the debits going to be? So let's just go through each one. So the book error, okay, so we know that it's going to be a credit to cash of $40. What should my debit be? What do you think? What was this for? So if we look back up here, it was to correct this. So what is it? What should we make the debit? Utilities, right? Utilities expense, probably. Yeah, because it's not a payable. This is actually us writing the check to pay it. So this is going to be utilities expense. Okay, so now this first one is accounted for. Next one, printed check expense. Okay, I'm kind of telling you the account here even. Okay, so printed check expense, debit, credit to cash. Again, cash is always going to be involved here because that's the whole point of this. Or was it 40? Sorry. No, 35. That's right. Okay. And then finally, bank fee expense, cash, 20. Okay. So now after I do these 3 journal entries, cash is going to be correct. And these 3 balances will also be correct. These 3 expense accounts. Okay, so again, everything that appears on the book side of the reconciliation, it is required that you do a journal entry to actually change the balances to reflect what those costs were, or those credits to cash or debits to cash. You need to actually go in and then debit or credit cash accordingly. Okay, make sense? Okay, all right, so let's do one more. This is 29A. Okay, so it's just the next tab over. This one is giving you a different format of the same process. It's just giving you a bunch of information. So for example, the ending balance of the bank statement. Okay, so it's telling you that piece of information. So what I would do if I were you is I would go through each of these and just start plugging them in to the reconciliation where they belong. So this first one, this is going to be the first line of this bank. This is going to be my unadjusted balance, unadjusted ending balance. for the bank side of the reconciliation, 4870. Okay, then I'd go to the next one, B. The bank statement includes two charges for NSF checks to customers. One is for 400, one is for 110. So the question is this going to go on the bank side or the book side? Who has an opinion on that? Yeah, Mohammed. Book side. Okay? Because this is checks that we included in our accounting system, but it didn't actually get deposited. So these two items are going to go on this side, on the book side, as subtractions from cash. Okay? So if I were you, I would just, again, go through each one of these and just put them into the proper place. And by the end of it, you'll have everything you need to complete the reconciliation. Okay, so that's how I would approach this particular problem. Okay, so why don't you guys try it on your own? Okay, so uh, bank statement includes two charges for NSF checks. It looks like the total is $510. So the first question is bank side or book side? Well, again, these were included in my counting books, but it turned out to like not materialize. So my counting books right now are overstated. So I'm going to have to adjust them downwards. Okay, so it's a book side subtraction. Okay, so um, I'm just going to call this NSF checks. It's $510 total. Okay, next one, checks outstanding. Okay, so again, these are checks that I've written. I debited cash in my accounting system, gave them to the person that I owed money to, but those people have not yet deposited the money. So it hasn't yet flowed through to my bank statement. So this is going to be a bank side adjustment and it's going to be a subtraction because right now my bank balance is overstated because when those checks get deposited, it's going to get lowered. Okay, so I'm just going to adjust the balance lower to kind of account for that inevitable deposit of the check. So if I sum this up, and again, I think the first one, just got to be a little careful to include because I think it's formatted as text. So I just change it to a number. And now when I add these up, I see it's $1,510. So I'm going to do bank side subtraction. This is outstanding checks. And I think I said it was, oops, there we go. 1,510. Okay. Okay, next. Stout Street Healthcare collects from a few customers by EFT. The bank statement lists $1,300 EFT deposit for collection on account. Okay, so this means that my customers, to pay off their accounts receivable, just directly send the money to my bank. Okay, so that means that my accounting books have not yet included this cash. Okay, because it went straight to the bank. They never sent me any notification of that. But now I look at my bank statement, I see, hey, my customer sent me $1,300. Okay, so that's going to be a book side adjustment, and it's going to be an addition. So EFT payments, 1,300. Okay, next. The bank statement includes two special deposits that I have not yet recorded. So it's clearly indicating that this is a book side adjustment because I haven't recorded these. Okay, so it's explicitly answering question one for me. $970 of dividend revenue and $80 of interest revenue. These are positive adjustments to cash. I'm receiving these amounts. Okay, next. The bank statement lists a $30 subtraction for bank service charge. So again, this is another book side adjustment because my accounting books, this is the first source document that I have for this bank fee expense. So now I'm going to have to do a journal entry eventually for it. But for now, I still am just going to record it as a book side expense for the purpose of my reconciliation. Okay. On August 31st, we deposited $350, meaning that we made a journal entry to deposit $350, but this deposit does not appear on the bank statement. So the wording of this also makes it extremely explicit that this is a bank side adjustment because it's saying it does not appear on the bank statement. So that means I'll have to do an adjustment for it. Okay, so this is an example of a deposit in transit. So this is going to be an addition, deposit in transit, $350. The bank statement includes $1,000 deduction for a check drawn by Easy Freight Company. Okay, so this is something that's included in the bank statement. We are saying that this is an error. Okay, so this is a bank error. They took $1,000 out of my account that they shouldn't have. So to correct this, I'm going to have to do a bank side correction. And we're going to have to add that $1,000 back because it was a mistake. They should not have taken it out. And they're eventually going to add it back. But for the purposes of our reconciliation, we're going to add it back now just because we want to reconcile our cash balance. So this is going to be another addition back to the bank balance of 1,000 to correct that error. Okay, and now it's telling me that my book balance is 2,900. So this is kind of the last missing piece here. We needed this piece here, the unadjusted balance on the book side. Okay, so now we have everything. We've gone through, we've corrected from A through I. All of this stuff, all this information is now reflected in this reconciliation. Everyone agree? We went through everything? So now it's like the moment of truth. We got to see if they're going to reconcile. So we are going to get adjusted balances for both of these. Let's be explicit. This is adjusting ending balance for the bank. This is the adjusted ending balance for the book. Okay, so I'll start with unadjusted plus the positive adjustments, which are these two, minus the negative adjustment. Okay, and I'm just going to do the same thing on this side. Start with the unadjusted balance, add these three minus the subtraction adjustments. Magic, they balance. Okay, now the last step would be to do journal entries for all of these. Okay, so this first one, okay, EFT payment 1,300. Okay, we're adding cash, so that's always, all three of these are going to be debits to cash. These two are going to be credits to cash. Now, what the other side of the journal entry is, it will depend, right? So for this first one, debit to cash, it's going to be a credit to what? It was for some payments on account. So what do I got to do? Credit to what? Accounts receivable. Okay, so there's some sale that I made. It was on credit, so I would have debited accounts receivable, credited sales revenue or service revenue or whatever. now that person is paying me off and they're no longer owing me money. So I'm going to reduce their account receivable balance. Everyone good with that? Okay. Next, dividend revenue. Okay, so again, that's debit to cash. It's simple. What is the credit? It's like the name of the adjustment. Dividend revenue. Is everyone good with that? Revenue, credit normal, right? So this is pretty straightforward. And then the other one was the same thing, cash, debit, but it was interest revenue. So similar. It was 90 or 80. Okay. And then these two NSF checks. Let's see, what was it for? Okay, so this was uh, kind of the opposite of this EFT. Okay, in this case, someone was paying me. In this case, two of my customers gave me cash checks to pay off accounts receivable, but they bluffed. Okay, or they messed up. Okay, so I actually had done this journal entry when I first received the checks, but I have to undo that basically. Okay, so it's just going to be these same two accounts but reversed. Accounts receivable. So I'm going to basically reinstate that receivable and reduce the cash balance um, in my accounting books. Okay, so now these people owe me that money. They gave me the checks. I thought they paid me off, but now I'm like, they didn't actually pay me off. They still owe me the money. So now I've kind of reinstated that account receivable. Okay, does that make sense? Yeah? Okay. And then this one is also credit to cash, $30. And it's for bank fee expense. Okay? So again, as we saw here, all on the book side, all of these adjustments need a journal entry. The additions, these are all going to be debits to cash and then something else credited, depending on what it was for. And these subtractions are going to be credits to cash and debits to, whatever account is related. Okay, you have to kind of understand what the adjustment was for to complete the journal entry. But at least you have half of it. They're always going to include cash. Okay. Okay. Um, the final topic is this cash ratio. Okay. Um, within current assets, because again, we have this idea that we want to see how well the current liabilities are covered by current assets. Because if you can't pay off your current liabilities, your business is going to run into problems, right? So we had the current ratio, right? Does everyone remember that? I think that was a couple of chapters ago. The current ratio is the most permissive, okay? Current ratio. You took all your current assets divided by your current liabilities, okay? So this is going to give you a ratio, and it's like useful because your current assets are theoretically going to be liquidated into cash. They're either cash already or they're going to become cash quickly, right? It's going to include inventory, accounts receivable, investment, the short-term investments. It's all your current assets. But as we saw with like Restoration Hardware, right? Their inventory is not as liquid as you would maybe want it to be, right? It might take 6 months for that inventory to turn into cash, right? So we're going to take this and make it a little, actually the cash ratio is the most stringent, okay? Of the current assets, which we said includes cash, AR, inventory, prepaid insurance, right? Prepaid assets. It's going to include all this stuff. we're going to now become on the extreme of only looking at cash. How much cash do we have? Forget about all the other stuff that we think is going to become liquidated. How much coverage do we have of just cash? Okay, so the cash ratio is the most stringent ratio of this type that's trying to answer this question. How much safety is there on my balance sheet to cover my current liabilities? So you can see here that the ratio is just your cash plus your cash equivalents divided by your total current assets. Okay, so it's the most stringent. We're going to see one that's in between. So the current ratio is the most lax because it's all current assets. The cash ratio is the most stringent because it's only looking at cash. Okay, and then there's a future chapter where we're going to learn one that's like kind of in between. Okay, that's the acid test, the quick ratio as it's called. Okay, so yeah, but again, there's a whole class of ratios that are trying to answer the question, how good is my company covering its current liabilities? Because that is the most immediate risk to my business going bankrupt. Is the current, if I don't pay my current liabilities, that's going to be a problem in the immediate future. So I want to make sure that I'm at least good for that. Of course, covering the long-term liabilities and all that is a different question, but the immediate need is to cover these current liabilities. And so we want to be able to use some metrics to answer that. Okay, all right, so that's it. We have spring break next week. Don't forget about that. I'm sure you haven't. So we will all reconvene in the week after. So have a good break. And we have a midterm. So if you got extra time, you may want to start reviewing for the midterm, which is the week after spring break. And your homework's due on Sunday for chapter 7. So don't forget about that. See ya.